start. 2, 1, boost ignition, and liftoff of the Space Shuttle Discovery, returning to the space station, paving the way for future missions beyond.
And as they say, what goes up must come back down again. And maybe so, but some things can reach truly impressive heights before they come back down. That's true of rockets, and it's increasingly true of the Dow Jones Industrial Average, which some forecasters believe will top 40,000 in the next few years. Will it actually do that? And if so, should you risk going along for the ride? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. The Dow Jones Industrial Average is one of the oldest and best known indices in the financial industry. As a benchmark for the largest stock market in the world, it has become an important barometer of global confidence over the years. The Dow has risen more than 50,000% over the course of its lifetime. It hit its highest record closing on October 3rd of last year, reaching 26,829 points. That followed a record set the previous day and was the culmination of a string of 96 new records that were set since the 2016 presidential election. Now, although the Dow has traded mostly sideways since its last peak, some analysts actually predict more record highs will occur before the next major sustained market drop. More accurately, they predict the Dow will actually avoid another major correction. And some say that the Dow will hit the 40,000 mark within the next few years. But what is that forecast based on, and exactly how feasible is it? Joining me will be Dr. Mark Skousen. He's investment expert, economist, university professor, and the author of more than 25 books.
Well, we're certainly at a situation where interest rates are still at extremely low levels on a historic basis, and there's some evidence that that will continue because remember, the baby boomers are now retiring. The supply of capital is increasing because people fear they'll run out of money.
Along with Eddie Gabor, the co-owner of Key Advisor Group in Delaware and the author of the new book, Common Sense Bull.
You know, the Federal Reserve has played a huge role in this. I mean, you can just take a look at the market action just in the last 6 to 8 months based off what Mr. Powell says. And it's amazing how much they can influence markets.
Of course, we also want to hear from you. Question becomes, will the trade war with China, the president's tariffs, and a disappointing jobs report lead to a U.S. economy into a recession? Or will the Federal Reserve's monetary policy help propel the economy and stock market to new record highs? Send us your thoughts by visiting theincomegeneration.com. But first, let's talk just a little bit more about the Dow's long, tumultuous history of highs and lows. The Dow Jones Industrial Average is actually the second oldest U.S. market index after the Dow Jones Transport Index. It was created by Charles Dow, a Wall Street Journal editor and co-founder of Dow Jones and Company. Now, the industrial part of the name is mainly historic, since most of the current 30 companies tracked by the Dow have little or nothing to do with traditional industry. When the Dow was first published in the mid-1880s, the index stood at a level of 62 points. Its up and down movement has been constant ever since then. But naturally, as the U.S. economy has grown and expanded, the Dow has ultimately continued climbing over the years, despite its many periodic downturns. Some of the biggest of those downturns occurred early in the Dow's history, as America's Industrial Revolution triggered economic growing pains. Now, although the Dow was created to gauge the performance of a collective of big companies, its movement has always been influenced not only by corporate and economic reports, but by many other factors. These, of course, include domestic and foreign political events such as war, terrorism, and elections, as well as natural disasters. Now, If you're a regular viewer, you know that I frequently point out that the Dow and other market indices are driven mainly by emotion, and there's primarily fear and greed. Historically, they reflect whether major investors are optimistic about corporate growth in the economy overall, or instead pessimistic. Events like war and terrorism obviously usually create fear and pessimism, such as when the Dow plunged 684 points after the 9/11 terror attacks back in 2001. Presidential elections that result in administrative change, on the other hand, typically fuel investor optimism, none more so than the most recent presidential election. Now, as mentioned earlier, the Dow has hit 96 new record highs since the president's election. Most of those records came in 2017 and followed the approval of the Trump administration's massive corporate tax cut. Though the effects of the tax cut wouldn't really impact the economic growth until 2018, investors priced that growth into the market early. And this is typical. Generally speaking, the Dow and the stock market overall is seen less as a reflection of where the economy stands at the time and more as an indicator of where investors think it's heading in the future. Now, that explains why, once the Trump tax cuts did start influencing corporate growth, even pushing GDP above 4% in the second quarter of last year, Wall Street didn't really celebrate. In fact, far from it. With tax cuts already priced in 2017, by the time the cuts did start having an impact last year, big investors had already turned their attention to other issues. Negative issues, such as the brewing trade war between the United States and China. And as a result, the Dow, S&P 500, and NASDAQ all experienced record levels of volatility in 2018. Despite strong growth and a fairly steady rollout of other positive economic data, fear and pessimism crept back into the markets. Although the Dow did manage to reach that record high of 26,829 points in October of last year, it spent half of 2018 in correction mode, meaning down by more than 10%. Overall, the stock market had its worst year in a decade in 2018, and its worst December ever. In one 7-day stretch in December, the Dow fell by 350 points or more, 6 times, and finished the year down more than 5%. In the first 4 months of the year, the markets managed to regain some of those losses, but the Dow has yet to best that record from October of last year. In addition, fear regained control over the markets once more back in May as President Trump again ramped up his trade war with China, and a flat yield curve triggered new fears of recession. The Dow fell below 25,000 for the first time since January back in May, and the S&P finished the month down about 6.5%. Now, what does this all mean? It means that the Dow has basically been trading sideways for about a year and a half. And that's not a change from the previous year and a half following the president's election. But it is a change from the previous 9 years. That's because the Dow and the markets overall have trended upward ever since recovering from their almost 60% correction in the wake of the financial crisis, as well as the Great Recession. I believe the drivers of that growth since 2009 have been mainly artificial, and that the Dow and other indices are overdue for another major sustained correction. This one in the neighborhood of 40 to 70%. We'll talk more about that in a bit, but coming up, I'll explain why some forecasters believe that the Dow will crack 40,000 within the next few years. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. And now it's time to bring in Dr. Mark Skousen. He's investment expert, economist, university professor, and the author of more than 25 books. He's also the editor of Forecasts and Strategies. Mark, thanks so much for joining us today.
My pleasure, Dave.
So, what do you think? You know, these forecasts so far we've been talking about on the show, whether it's Dow at 40,000 in 2 years or even Dow at 40,000 in 6 years. Possible? Probable? Not probable? What do you think?
Anything's possible. I mean, we're in the mother of all bull markets that have lasted over 10 years. So a lot of people are thinking this is the longest bull market in history. We need a breather. We need a correction. Certainly a recession. If we had a recession in the next year, you'd see the Dow come down. But there's nothing that I see in the horizon that would cause a major recession. Certainly, if we adopt protectionism as a permanent policy instead of a trade negotiation, that could really hurt the United States in the long run. Globalization has been really good for America overall, but we don't really know if it's just Trump is involved with the trade negotiation, or there's a lot of indications that he actually believes in protectionism and America first and so forth. And if he does, that's a dangerous strategy.
But if he doesn't, and let's say we get sometime later in 2019, we get the trade deal worked out, then the Dow at 40,000 in 6 years, as some say, isn't really that crazy. That's an average growth of 6.75%. Throw on some dividends, it's probably an average return of 9%. So in essence, then, what you're saying is if you're right, and if we could avoid any recession or certainly major recession, it's not crazy to think a Dow at 40,000 in 6 years.
There's three factors to look at. Fed policy, if they get too tight, that could hurt the economy. Adopting socialism, which I would include protectionism in that category, and overregulation. And then finally, just a major geopolitical event, whether a war or terrorist attack, could all knock the Dow down for a while. But American exceptionalism is still very much in play. The U.S. markets have led the rest of the world. I see that trend continuing if we encourage entrepreneurship and supply side policies, the tax cuts and deregulation that Trump seems to be supporting.
So, in the 1 minute we have left in this segment, let's talk about Fed policy. Has the Fed contributed to any signs of recession that economists are seeing? I know you don't see a ton, but there are some. Has the Fed contributed to that? And conversely, what should the Fed do to fix it?
Well, when the Fed engages in too easy money policies, and the low interest rates and easy money quantitative easing that we've seen recently, that causes a artificial boom that will result in a bust at some point. But I'm relatively optimistic, have been. I'm 100% invested at the present time. So if the Fed keeps raising rates, doesn't look like they will, then I think we could continue to see a growth pattern both in the Dow and in the economy. So I don't see a recession at this present time.
Interesting. You are looking for the opposite of what all the so-called drug addicts are looking for on Wall Street. And I want to talk to you about that just a minute right after the break. So stay with us. And you stay with us too. We'll be back here with more on the income generation. We'll be back in a moment. I often say that no one has a crystal ball. Or as the great Yogi Berra once put it, projections are hard to make, especially about the future. The point is this. Obviously, no one knows for sure what's going to happen with the Dow, the financial markets, or the economy in the near or long-term future. The best that any economist or any market analyst like myself can do is review all the evidence, consider it in the context of market history, and then build a forecast based upon that. And if you're a regular viewer, you're probably familiar with the gist of my forecast, which stems from the premise that the financial markets ultimately have to obey the lessons of market history and at some point make fundamental sense once again. We'll talk more about this later on in the show, but right now, let's talk about why some of the forecasters are predicting the markets will actually defy history this time around, and that the Dow specifically is poised to keep climbing all the way to the moon. There's one forecast out there, for example, that predicts the Dow will hit 40,000 by 2025. And this actually isn't all that outrageous, provided you're willing to make a few assumptions that, personally, I can't buy into. One of the chief arguments behind this forecast is that the current bull market hasn't actually been running since 2009, as most people believe. This forecaster argues that since some indices experienced temporary dips as steep as 20% back in 2015 and going into 2016, that the 2009 bull cycle ended at that point, and a new one began with the 2016 election. That makes the current bull market seem like less of an anomaly, historically speaking, and makes the idea that it could continue for another 6 years seems less outrageous. Here's the trouble, though. That's not really how long-term secular bear markets or short-term cyclical rallies work in the real world. Not only hasn't the bull rally that began in 2009 officially ended yet, but neither has the long-term secular bear market cycle that began in 2000. And we'll discuss that in more detail later on in the show. But another premise to this 40,000 or so Dow by 2025 theory is that the economy will ultimately triumph over brewing threats like the flat yield curve and the escalating trade wars, and will continue growing. Specific indicators cited include a high unmet demand for housing, rising consumer confidence, continued job growth, and strong corporate capital spending. But here's the trouble. Some of these indicators have been significantly downgraded only really in just the last few months. The Department of Labor released a disappointing jobs report in May. And increasingly, the trade war and yield curve have companies amending their forecasts, and many experts speculating about a new recession in 2020. So again, the idea of the Dow making it to 40,000 or so by 2025 isn't that outrageous mathematically. It would only need to increase another 6.75% annually, not including dividends. But it would also need to avoid the kinds of sustained market corrections that occurred from 2000 to 2002, and then again from 2007 to 2009, when the markets fell by nearly 50 and 60% respectively, and each time took 6 to 7 years to recover back to their previous highs. Now that, in reality, is how a long-term secular bear market cycle works. And I personally am not one ready to accept the premise that the one we're currently in is going to defy history and avoid a third major sustained correction. And again, yes, we will talk about that just a bit more in the show. But interestingly, there is more than one theory out there right now about the Dow hitting 40,000 in the near future. Another proposes it will be the very near future, but that the trajectory won't be smooth. Basically, this theory is that the Dow will hit 40,000 within the next 2 years, but that a major panic event will occur first, possibly within the next 6 months, and briefly drop the index as low as 21,000. The theory here is that this event will be similar to, but worse than, the huge market plunge that occurred last December when the Fed actually approved its fourth interest rate hike of the year, despite stagnant bond yields and the increased risk of a flat yield curve. While the Dow and the other indices were able to partially recover those losses early this year, this theory about next panic is that not only will the Dow quickly recover, it will continue climbing, quote, straight up to levels never seen before. Another interesting thing about this theory is that it concedes that economic growth is increasingly slowing, and that the inverted yield curve is a possible warning sign of a coming recession. So, to accept the theory of the Dow hitting 40,000 in the next 2 years, you have to accept the premise that the stock market will not only avoid the next major sustained correction, but that the markets really don't ever have to actually make fundamental sense again. And again, while no one has a crystal ball, granted, I personally and professionally don't accept either premise and have my own theory where the Dow might be headed in the next 2 to 6 years. Now it's time to bring back our friend, economist and investment expert, Dr. Mark Skousen, author of Forecasts and Strategies. So Mark, you know, it's funny because I mentioned this right at the end, so many of the Wall Street drug addicts, if you will, the ones that are addicted to this drug of quantitative easing, seem to want the Federal Reserve to go back and ease again. You're saying that easing could actually create a recession. You really want to see them stay level with interest rates, or maybe eventually raise rates slightly and cautiously. Am I hearing you correctly?
Well, we're certainly at a situation where interest rates are still at extremely low levels on a historic basis. And there's some evidence that that will continue because remember, the baby boomers are now retiring. The supply of capital is increasing because people fear they'll run out of money. So interest rates could continue to decline. This is very bullish for the stock market and the economy if that trend continues. So I see no reason. I think it's just happening in and of itself. There's no reason for the Fed to push it along by expanding the money supply and trying to get inflation going again. A lot of people are saying, well, they need to inflate more. I don't think so. I think they should maintain a stable course and let interest rates fall if that's what the bond market is telling them. And I think that's what is happening. So I think there's reason to be optimistic about what is happening as long as the Fed doesn't tighten too much and create what we call the inverted yield curve, where short-term rates are higher than long-term rates, and it is at that level right now.
That's right. That's right.
That is a danger sign. I don't think it's too serious this time because interest rates are falling across the board. It's just which rate is falling faster, short-term or long-term rates.
Now, it's interesting. You know, Mark Faber was a guest on our show last week, and he said that in reality, we are seeing inflation, that the Fed is looking at the old textbook definition of inflation, but asset inflation should be counted. And if you look at asset inflation, we are seeing inflation. We are seeing a result from all the quantitative easing and the increase of the money supply. Have you ever thought about it quite in that way?
Well, yes, and as a practical person, we see this all the time. There's some disconnect between the consumer price index, the CPI, and what's happening in the real world. When you send your kids to college, you pay for an accountant, you go out to dinner. There's all kinds of, you can't just look at fast food and what's happening in the grocery store. You need to look beyond that. And so, but this idea that the Federal Reserve should stimulate inflation, I don't think that's a good idea at all, because that can create an artificial bubble as well. And we have seen it in real estate prices are increasing rather dramatically. So I'd like to see, gold is a good indicator. Gold is relatively stable, but it is moving back up. And that's a sign that inflation is picking up. So that's a danger sign.
Yeah. And like you said, you're trying to avoid any major pullbacks in the market, which if the Fed should lower interest rate eventually, short term, it might be okay for the markets. Long term, it's just a bigger bubble. But I need a few minutes because I have to ask you about this Freedom Fest that you're sponsoring. Tell our Income Generation members about this, please.
Yeah, Freedom Fest is an intellectual feast in the entertainment capital of the world. So we meet in Las Vegas every year. This year it's July 17th through the 20th. We have over 2,000 people coming. Newsmax has been there a number of times. And we have Kevin O'Leary of Shark Tank fame coming, debating John Mackey. We've got Penn Jillette of Penn and Teller. We have Steve Forbes and Steve Moore coming, people who can talk about government policy and what's happening in the world. So if people go to freedomfest.com, they can find all about it.
I want to go there just to be able to play blackjack right beside some of these intellectuals. It might increase my odds a little bit. Thanks so much for being on the show. We really appreciate you being here, Mark. Thank you.
Yeah, my pleasure, Dave.
And you stay with us too. We'll be right back here on the Income Generation. Is it actually possible the Dow Jones Industrial Average will reach that lofty new peak of 40,000 or so within the next 2 to 7 years? Of course it's possible, but only because, broadly speaking, almost anything's possible. But the question becomes, the more important question that is it probable? Well, I've been studying, following, forecasting financial markets professionally for 32 years now. And based upon my analysis of all the available data, I say no, it's definitely not probable. And even if I thought it were, I still don't think it would have much relevance for retired investors or those within 10 years of retirement. See, investors whom I believe should be shifting their focus away from financial strategies geared toward market growth, instead, alternatively, toward strategies geared toward protection and income. I've already hinted at the major reasons I reject these recent 40,000 Dow theories, namely my firm belief in the lessons of stock market history and the consistency of long-term secular market cycles. Now you can add to that my belief that while the Fed's unprecedented artificial manipulation of the markets might have delayed the next major market correction, ultimately it can't prevent it. Now, in case you haven't heard me discuss long-term secular bear markets before, here's a quick refresher to help put my own theory about the Dow in context. From 1899, yes, I meant to say 1899, to now, the stock market has experienced extended periods of 12 to 15% growth, followed by slightly longer periods of zero net growth. These are long-term secular bull and bear market cycles, respectively. The long-term growth or bull markets have lasted roughly 10 to 15 years on average, while the zero-growth secular bear markets have lasted 20 to 25 years. And within each long-term secular bear cycle, the markets experienced at least 3 major market corrections. That's why these cycles yield zero net growth for buy and hold investors, who ride all these major drops from top to bottom each time. The drops end up washing out all the gains. So where are we today? Well, the last long-term secular bull cycle was the longest ever, running from 1982 through the year 2000. Then, when the dot-com bubble burst and the market crashed from 2000 to 2003, it then signaled the start of our current long-term secular bear market cycle. The market recovered to its previous peak by 2017. Then, in keeping with history, the second major drop of this secular bear market cycle occurred from 2007 to 2009. The market recovered again by 2013, but that's when something happened to interrupt the normal flow of history. That again was the beginning of the Fed's unprecedented overuse of artificial stimulus known as quantitative easing. Its influence has helped keep a third major drop at bay since 2013 and helped make the current cyclical bull rally by far the longest in stock market history. And today, the Dow and all the other market indices are still being influenced more by artificial factors than by economic fundamentals, a fact that contributes to what I call the unprecedented age of economic uncertainty. Now, the important thing for investors in or nearing retirement to understand is that extended periods of volatility, like we experienced through 2018, or even short-term corrections of 10 to 20%, don't really mean much in the broader context of long-term secular market cycles. Yes, they can be and often are warning signs that the next major sustained market correction may be on the horizon. But that's not always the case, especially in the last 10 years, as this artificially inflated market has continued to defy odds. Now, in spite of all that, history and other evidence still overwhelmingly suggest that the long-term secular bear market cycle that began in the year 2000 hasn't ended yet and still has at least one major sustained market correction yet to go, possibly as steep as 40 to 70%. Among that, other evidence is the status of corporate PE ratios, price-to-earnings ratios, which typically shrink down into the single digits before the end of a long-term bear market cycle. Current PE ratios are still around 20. In other words, if the Dow were to avoid another sustained correction and make it to the 40,000 level in the next 2 to 6 years, it would mean our current long-term secular bear market cycle really did end in 2013, when the Dow and other indices regained their previous peaks. As I mentioned before, that would also mean that the secular bear market cycle essentially set 3 world records. 1, the shortest secular bear cycle in history. 2, the first such cycle to end with less than 3 major sustained drops. And 3, the first to end with PE ratios still in double digits. I think most people would agree setting 1 world record in a lifetime is unusual enough. But 3? Again, anything's possible, but not always probable. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Now it's time to welcome our next guest, the common sense bull, Eddie Gabor. He's the co-owner of Key Advisors Group in Lewis, Delaware. He's also the author of the Amazon bestseller, The Common Sense Bull. Eddie, thanks for being back on the show.
Thank you for having me.
Of course, the most important part of the introduction that I failed to mention is that you're not only all that, but you're also a good friend of the income generation and a very close friend of yours truly here, your host, David Scranton. So we always get all these people here on the show that are these bears, right? So as the common sense bull, I know the extreme bulls say Dow at 40,000 over the next 2 to 6 years. What does a common sense bull say, though? Do you say that's possible, or do you say that's a bunch of bull?
You know, I think anything is possible, as we all know, right? But the fact of the matter is, using our common sense approach here at our firm, I think it's too difficult to predict 40,000 based on where we are now. There's a lot of factors that have to really fall into place for us to hit that 40,000 mark. Because I think before we hit that 40,000 mark, I would expect to see some double-digit drops on the way there. So will it get to 40,000? Eventually, but I think the path getting there will not be straight up. It will be a choppy path there over the next several years.
Now, of course, we talked earlier in the show about one particular analyst who's calling for 40,000 next 2 years, but he's calling for the Dow to have a big drop below 21,000 first, then for it to turn around and skyrocket up to 40,000. Are you seeing this to be able to happen in that short of a period, such as 2 years, or do you think that's perhaps too radical of a prediction?
You know, in my opinion, I think that's probably too radical of a prediction, because one thing right now that I think people need to be aware of is we are late cycle. I've been very bullish, as you very well know, but we have definitely started to become a little bit more cautious in the second half of this year because we've had a heck of a run and we're starting to see some red flags out there, such as the inversion of the yield curve.
Mm-hmm. So what's a bigger red flag? Is it the inversion of the yield curve? Is it the tariff, the so-called trade war with China? Is it some of the manufacturers index that have come out recently? Is it the Federal Reserve statements? What do you think the two biggest issues are right now that could cause a recession coming up, let's say, in the end of the next year and a half or so?
The two biggest things without question are the tariffs with China and the inversion of the yield curve. If we don't get some type of trade deal with China by the third quarter or even towards the end of this year, my opinion again is that I think we have a very high likelihood to see a recession towards the end of next year. That's how big of an impact this has. And then again, you have that coupled with the inversion of the yield curve. Those are two major red flags that the common sense bull right now is becoming a little bit more cautious with our portfolios and becoming more defensive, because if those two things don't shake themselves out, it's going to be a rocky road for the market heading into next year.
Well, that's what I love and respect about you so much, is that a lot of the bulls on Wall Street are just bulls, but you are the common sense bull. We need to take a commercial break. When we come back, though, Eddie, we're going to talk about specifically about the inverted yield curve and what your thoughts are on the job the Federal Reserve is doing. We also want to talk about what everyday investors can do to protect themselves at a time like this. So, Eddie, please stay with us. And you stay with us, too. We'll be right back here with more on the income generation. You're watching Eddie Gabor and David Scranton, and we will be right back.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Whenever I'm doing a financial education workshop, I often ask people what they believe the average stock market return is over the long run. And the answer is typically the same. Most people have been told or taught that the stock market averages a 9 to 10% return over the very, very long run. But here's the trouble. Most people don't bother to question what the very long run actually means. But once you start to understand the reality of long-term secular market cycles and how they work, the answer becomes clear. Now, as we've discussed, long-term secular bear market cycles last typically 20 to 25 years on average, while long-term bull cycles last 10 to 15 years on average. That's how long it takes for the market to go through one full cycle of losses and gains. 35 years. That's the very long run that everyone talks about. In other words, statistically speaking, if you have money that you know for sure you're not going to need or want to spend for 35 years, you should in theory be able to put it in the stock market and have it outperform virtually every other investment. But obviously, if you're retired or near retirement, you simply can't even begin to afford to wait 35 years for your money to deliver a great return. Instead, you need to deliver a good, competitive, consistent return to meet your income needs over the next 30 years or so. That's why I say, even if the idea of the Dow hitting 40,000 within the next 6 years were probable, which I don't believe it is, it would be largely irrelevant for investors in or near retirement. Because in order to benefit from those gains, you need to stay invested in risky growth-based financial strategies rather than making that all-important paradigm shift from growth to income. Because once you actually make that shift, you may never achieve maximum return in the form of capital appreciation, even if the Dow does hit 40,000. But you also don't have to risk losing 40 to 70% of your savings in the next major market correction. And you can still enjoy a good competitive return in the form of income with the right actively managed income-based strategies. In fact, as I pointed out before on the show, since the turn of the century, buy and hold stock market investors have experienced an average return of only 5%, including dividends, not 9 or 10. Why? Because of those two major corrections from 2000 to 2002, and then again from 2007 to 2009, which washed out all previous gains and actually forced investors to start building again from square one. By comparison, many income-based investors whose portfolios were properly managed have also seen returns of 5% or even higher since the turn of the century, and gotten those returns in the form of consistent interest and dividends. At the same time, they've been able to enjoy those returns knowing their principal secure and much less vulnerable to the volatility of the next major sustained market downturn. Again, understanding the lessons of market history and how stock market cycles really work over the very long run is, in my experience, one of the keys to successful investing, which is exactly why educating investors like you about these cycles has actually been a top priority of mine for 20 years. Yeah, it's time to welcome back Eddie Gabor, author of the Amazon bestseller, The Common Sense Bull. So, Eddie, the slowdown in the economy, how much of this, in your personal opinion, do you think is due to the actions of the Federal Reserve over the last year and a half?
You know, the Federal Reserve has played a huge role in this. I mean, you can just take a look at the market action just in the last 6 to 8 months based off what Mr. Powell says. And it's amazing how much they can influence markets because, you know, one could argue that they should have been raising rates and the real rate should be back up to 5%, but they continue to get scared with the economic data that comes out. And now all of a sudden, instead of raising rates, they're talking about lowering rates 2 to 3 times over the next 12 months. So they just seem to be very inconsistent in their message.
Yeah, they're kind of giving me whiplash, I have to tell you, on this show, because on one episode, you know, we're talking about the next rate hike, and all of a sudden, one episode later, we're talking about when the Fed's going to cut. So what, in your opinion, does the Fed need to do to get it right? To fix this flat yield curve that's inverted in some parts, to at least maybe kind of sort of help stave off a recession in some way?
Well, I think the first thing is I think they made a major misstep in December when they raised rates when everything was saying not to. And now they're in a position where they're trying to play catch up, in my opinion. So right now, they're kind of been pigeonholed and forced, in my opinion, that they're going to have to actually cut rates to get that inversion from happening and becoming even steeper. Because as you well know, the longer this inversion stays in place, the higher the likelihood that we are going to be going into a recession. And anyone that ignores that, I think they're not being fair or honest to themselves.
Or they could just start reversing quantitative easing again, which they're stopping the reversal of quantitative easing between now and September. That didn't make any sense to me when they announced that. Did it make sense to you?
No. And the other thing, too, is when you look at some of the statements they've made, they tried to project out. Last time they met in March, they were projecting out 2 years and saying they were going to do rate hikes. I think trying to project out 2 years in this crazy economy is just going to prove that they're going to be wrong, and then it hurts their credibility. So I think he just needs to go month to month. That's
right. Well, you said it'd be crazy to try to, predict whether the Dow is going to go to 21 or to 40 in the next 2 to 6 years. So I at least appreciate your humility. I wish the Federal Reserve shared just a little bit of that with you. We need to take a commercial break. We'll be right back in a minute. Welcome back to the Income Generation. I'm David Scranton, and we're here on this final segment with our good guest, friend of the Income Generation, Eddie Gabor, who's also the author of the Amazon bestseller, Common Sense Bull. So, Eddie, what makes you different from a lot of our guests, our previous guests on the show, is that you're in the saddle. You're in Delaware. You're talking to average clients, just like our Income Generation viewers, every single day. So in a market today, in an environment today, an economy today, it seems to be so questionable. What are you telling them they should be doing to protect themselves if they're either retired or, as most of our audience, within 10 years of retirement?
So what we've been really talking about here recently is focusing on the equity side. We've been reducing equity exposure for clients because, again, they've had a heck of a run so far this year. And on the equity side, we're focusing on high-quality dividend-paying companies. One big issue is corporate debt. As you know, when we go into a recession, these companies that are over-leveraged are going to have some serious problems. So quality, dividends, and income within a portfolio at this point in time for our client base, we feel is the main focal point of where they need to be to try to reduce volatility as much as we can as we head into uncertainty over the next few months.
So reducing equity exposure, and the equity exposure that's remaining, you're putting more into blue chippy dividend type stuff. So you're really a man after my own heart when it comes to that. I agree completely. But how about the rest? How do you, like you said, some companies that are over leveraged, you have some potential risk when it comes to corporate debt. So what do you do to protect your clients against that on the non-stock market side? What do they need to know?
So I think one thing that we've done is we've tried to focus on the fixed income side of using individual investment grade corporates versus bond funds. We feel as though there's some potential hedges there for losses. The other thing, too, is the inversion of the yield curve. Cash is actually paying something right now. And so we have a cash position right now for our clients. So that way, if we see major drops, it allows us to be opportunistic and potentially buy those dips.
It's funny. I see this, too, sometimes with my clients. And I always have to remind everyone that cash is an asset class. When they see money sitting in cash, they think, why am I paying you this fee to sit in cash? When really cash is an asset class, right? And sometimes it could be the best asset class, right?
It is. And, there's a saying that says cash is king, and there's a reason why they say that.
Yep, that's right. That's right. So 10 seconds. Any final words of wisdom for Income Generation members?
Only thing I can say is this stage of the cycle with the inversion of the yield curve, with the Fed being on shaky ground and with tariffs potentially on the horizon, focus on risk management. Look at it now to see the risks you're taking. Don't wait until there is a drop to then try to figure it out.
There you have it. Some great words of wisdom from our good friend Eddie Gabor from the great state of Delaware. Eddie, thanks so much for being back in the show.
Thank you, Dave. I really appreciate it.
And you stick with us. We'll be back with our final segment here on the Income Generation in just a moment. I'd like to thank all of our guests for joining us for another episode of the Income Generation, but I'd also like to thank you, our new and returning viewers. As we've discussed long-term secular market cycles today and other aspects of market history, you may have wondered, why don't I ever hear other advisors or market analysts on television talking about this stuff? And it's true. When most experts in the financial media talk about bull and bear market cycles, they conveniently omit discussing long-term secular cycles. They focus instead on short-term cyclical cycles that occur within the longer patterns, never making the distinction between these different types of cycles. To them, all bull and bear markets last a few years at most. But the question becomes, why do they do this? Well, it's all tied to what Wall Street itself does and doesn't want the average investor to know, and to its need to speak optimistically about the markets as often as possible. Here's the reality. A Wall Street CEO can speak optimistically more often if he pushes the idea that all market cycles only last a few years. That idea allows him to push one of Wall Street's favorite mantras over and over again. Hang in there, the market always comes back. As I've discussed on other shows, this need to push optimism spreads from Wall Street through most of the financial media, creating a sort of optimist club, one which many advisors also end up joining. They join it because it's easier to toe the party line and to push simple ideas than it is to explain the true complexities of long-term secular market cycles. It's also easier to stick to a conventional stock and mutual fund-based business model than it is to specialize in strategies that account for the reality of secular market cycles, those strategies that actually protect investors against their risks. So think about all that in relation to today's topic. The possibility of the Dow Jones Industrial Average avoiding another sustained correction and hitting 40,000 within the next 2 to 6 years. That sounds pretty optimistic, doesn't it? And it's certainly possible. But in the context of market history and everything else we've discussed, does it sound probable? Again, personally and professionally, I don't think so. Thanks for watching. If you're close to retirement and really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.